All right, today we're diving into the latest numbers from a company I bet you have in your garage or under your sink, Stanley Black Decker. And trust me, inside this report is a really interesting story. It's about a company that's kind of at a crossroads. So let's do a quick financial health check and see what's up.
We're talking about everything from DeWalt power tools to Craftsman lawnmowers. This is a huge global player. So when we look at how they're doing, it's not just about them. It's really a sneak peek into the whole consumer and pro tool market.
And boom, right out of the gate, we hit this central puzzle. The report shows that their total sales, well, they didn't really grow at all compared to last year. But here's the kicker. Their profits actually went up. So how in the world does that happen? That's the big question we're going to solve right here.
The company's own CEO, Christopher J. Nelson, kind of sets the stage for us. He's framing their results as a win, especially in this tough economic climate. And you'll hear this phrase, macroeconomic uncertainty, a lot. That's super important. It's the challenging backdrop for, well, everything we're about to dig into.
Okay, so first things first, let's look at the top line, the revenue. This is where we start to pull apart that puzzle of flat sales.
So check this out. This is a perfect picture of a tug of war. On one side, you've got the company pulling sales up by a total of 6%. How? Mostly by raising prices. But on the other side of the rope, they're getting pulled back by the exact same amount, a 6% drop in the actual number of things people bought. This probably reflects what we're all seeing, that post-pandemic DIY craze is cooling down, and with inflation, we're all thinking a little harder before buying a new tool. The end result? A total stalemate. That's why sales were flat.
All right, so if you can't get more people to buy your stuff, what's your next move? Well, Stanley Black Decker had a very, very clear answer. Let's take a look at their core strategy.
Their main play? A huge global cost reduction program. Seriously, this has been their focus for a couple of years now. It's their primary weapon for fighting back against this tough economy and making sure the bottom line stays healthy.
And the scale of this thing is, wow. Since this all started back in mid-2022, they've managed to slash a jaw-dropping $1.9 billion in costs. Now, this isn't just, cutting back on office supplies. This is a massive business transformation, changing everything from how they get materials to how they make their products and get them to stores.
They originally set a goal of $2 billion in total savings, and as you can see, they are right at the finish line. This is a huge piece of our puzzle, right? It explains exactly how profits can go up, even when sales are just stuck.
So, now let's get to the bottom line. How did all that cost-cutting actually shake out when it comes to profits?
And here's the thing, the strategy is definitely working where it counts. The company's gross margin, which is basically the profit they make on every dollar of sales before all the other corporate expenses kick in, it's up. It jumped from just under 30% last year to over 31% this quarter. That's proof right there that the cost savings are directly boosting their profitability.
So this seems like a pretty simple success story, doesn't it? Spend less, make more profit. But, whenever you're digging into a financial report, the really juicy details are often buried in the fine print.
And that is exactly what we find here. There's some pretty big one-off accounting charges that add a big ol' asterisk to this whole positive profit story.
First up is this monster number. The company took what's called a non-cash asset impairment charge of over $169 million in just this one quarter. Okay, so what on earth does that mean? Basically, the company is officially saying, hey, some of our stuff isn't worth as much as we thought it was. In this case, it was all tied to a big shift in their brand strategy, and it dinged the recorded value of some really well-known names, like Lenox, Troy-Bilt, and Irwin. Now, this doesn't actually affect the cash in their bank account, but it does take a bite out of their reported profits on paper.
The second red flag is a legal one. The U.S. Consumer Product Safety Commission has passed an investigation over to the Department of Justice. The allegation is that the company was too slow to report problems with some recalled utility bars and miter saws. The initial recommended penalty was around $32 million, and now this whole thing is an ongoing matter with the DOJ.
All right, now let's slice up the company into its main parts. It helps to see where the real strengths and weaknesses are hiding.
So their two main businesses are telling kind of different stories here. You've got tools and outdoor, that's the biggest piece of the pie by far, and its sales were flat, pretty much just like the company as a whole. But then look over at engineered fastening. This is the division that makes super specialized parts for cars and airplanes. It actually saw its sales grow by 3%. Why? Well, it was driven by stronger demand in those auto and aerospace markets.
Okay, Finally, let's put it all together and see how this affects the company's forecast for the rest of the year.
And here it is. This is the impact of those little asterisks we found earlier. The company had to significantly chop its official earnings per share forecast for the whole year, and it's a pretty big drop.
So why the big change? It comes right back to that $169 million impairment charge we talked about, because that's a hit to their official profit calculation. It forces them to lower their full-year earnings guidance. Simple as that.
But, and this is a really important but, you have to remember that impairment charge is a non-cash thing. It's just an accounting move. The company's forecast for generating actual real cash from its day-to-day business, that hasn't changed at all. It's still holding steady at around $600 million for the year. And that tells you the underlying business is still chugging along just as they expected.
So when you wrap it all up, what have we got? Stanley Black Decker is showing some serious discipline. They're proving they can control their costs to protect profits when sales are just stuck in neutral. But the big forward-looking question this report leaves us with is this: can this really effective defense pivot to offense? Can they find a way to actually reignite real sales growth in what's still a really tough market?